There are two different price action concepts that, when combined, personally make one of my favorite trading models to follow in the market. In this video, I'm going to talk a lot about liquidity and market structure and how you can use that together to create high probability trades and to make money in the market. So, the first thing that you guys need to understand is, what is a swing high? What is a swing low? What do they mean? Why is it important? Okay, so a swing high, a swing low, in the simplest terms, right, is showing us where buyers and sellers have transacted in large amounts, right? Because that's how markets go up, that's how markets go down, right? So what we do know is, if we have a swing low, for example, down here, okay, then there's resting liquidity below, because a lot of people are going to be placing stop orders or stop losses below that swing low, as well as the swing high, right? So this is where what's called resting liquidity is. Write that out. Resting liquidity. Okay. Right. So resting liquidity, basically what that means is, it's where we know there's a pool of liquidity of stop or buy orders inside the market based on market structure, right? This is market structure. We have a swing low, we have a swing high. This is creating structure, right? So this is creating what could be the start of an uptrend, a downtrend, vice versa, right? But what we do know is, below highs and lows, we have what's called liquidity. Now, what you need to understand is, big market participants cannot hit the button to buy and sell like we do. They can't just enter the market with the click of a button, buy and sell, get in, get out. They need to extract what's called liquidity. Sometimes they have to engineer this liquidity to be able to enter the market, right? So in order to do that, they create these highs and lows, right? So that way retail traders or inexperienced traders will place their stop orders below these highs and lows. So then they can run price into those highs and lows to stop traders out, to then get entered into the position. Because without the liquidity, okay, without hitting this liquidity, those big market participants cannot enter the position that they want to get into. So you have to basically engineer that liquidity, or take out buyers or sellers within the market, okay? So that is the first thing I want you guys to understand, right? Swing highs and swing lows are basically points of liquidity, okay? Big market participants cannot enter the market until they stop out those smaller traders, right? Those retail traders or inexperienced traders, right? Sometimes it is experienced traders. Sometimes you'll see, you know, institutions go after institutions, so to speak, right? Like, they stop each other out. The point that I'm trying to make is, they can't do anything in the market until somebody is having to hit a stop loss, right? That's the point I'm trying to make. So that's what I'm kind of illustrating with this, and let me break this down into a little bit more of a uh, defined example. Okay, so what I want you to look at here is, what can we first notice? Okay, we have all these swing highs. We're creating liquidity, right? So we're trending down, right? And what are we doing when we trend down? We're breaking these lows. This is a break of structure, right? So as a break of structure, we're breaking lows, breaking lows, breaking lows, right? We're creating this trend down, and we have what we have here, all these swing highs, right? These swing highs are points of liquidity, right? So if everybody's shorting, right, inside this market, right, everybody's short in this trend down, everybody thinks the market's going to continue to go down, then what happens? The liquidity dries up. Okay, so if institutional or big market participants want to join in on this trade, they want to take shorts, and this move has already occurred, what do they need to do? They need to run highs, so that people that are already short or poorly positioned short are going to get stopped out at their stop loss, so then that they are forced to buy within the market, right? Because when you get stopped out on a short, you're forced to buy. When you get stopped out on a long, you're forced to sell, right? So if I want to sell this market, but I need someone to buy my order so I can enter my sales, then I need to force somebody to buy an order so I can sell to them, right? So that's what this is, right? So what we have here is what is called an equal high, right? So this is a great liquidity point, because not only do we have a high from this downtrend within it, but we have an equal high. What do retail traders like to do? They like to put their stop losses above and below double bottoms, double highs, right? Or equal highs, equal lows, right? This is what all the textbooks will tell you, right? But the institutions, they understand this, they know this. So what they like to do is, they like to run price into these points where they know a lot of retail traders are going to be positioned. stop those traders out, and usually they run price into what's called a POI. Now, what is a POI? A POI just stands for point of interest. I'll write that out. Points of interest, right? And now what is a point of interest? Okay, so a point of interest just means this is an area of price or a price level that big market participants, for whatever reason, right? You'll never know the reason, but for whatever reason, they had an interest in this price level, right? This is where they want to get in. This is where they want to buy and sell. This is their point of interest, right? Now, how do we define a point of interest? There's a couple different ways. I go through it inside my mentorship, link down below if you guys want to check it out. But I use different concepts. I use supply and demand. I use higher time frame fair value gaps. I use the volume profile in various ways. I use also what are called ghost gaps, right? These are different concepts. Some of them are proprietary that I've created over the years that I've been trading. So I can't share it in this video, but they're all classified under the same umbrella as a POI. This is a price level that has been identified as having institutional sponsorship, where institutions are interested in taking buyers or sell positions at, right? If you want to learn more about that, if you want to get mentored by me, like I said, that link is down below. You guys can also join the Discord. It's completely free to join the Discord. Okay, we all like to help each other out here. There's a bunch of good people. But if you do want to get mentored, if you want to learn more about my entry model and my POIs, then I do offer that link down below. But so what do we have going on here, right? We have liquidity here, right? This liquidity is getting stopped out as price runs up. And what do they run into? This POI, right? So this price level that happened before a large move, right? Whether it's supply and demand or ghost gap, fair value gap, or some kind of that volume profile concept, right? These are all just points of interest, right? So we run price into a POI, right? And then we have an entry model to then confirm an entry short that we're not going to continue to just run up and then create a trend higher, right? And if you want to learn my entry model, how I differentiate that and confirm what I call a mic model, which is what I trade. Like I said, that's all in my mentorship. You can learn more about it, link down below. But I'm just trying to give you a basic understanding of what price action is doing here, right? So we're tapping into a point of interest, right? We're sweeping out liquidity, engineered liquidity, right? And then now all these traders that were poorly positioned here for shorts are getting stopped out, creating an opportunity for big market participants to now enter the market and take the shorts they want to take. And that's how you get these big impulsive moves, right? And where are they taking it? They're taking it at a point of interest, right? Where they have an interest in price going, an interest in price to go long or short, right? But what they're always going to do is, like I said, take out some form of liquidity, tap into that POI so they can actually enter at the price level they want to enter, because they can't do it if there's nobody to take the other side of that order, right? So that is basically how liquidity and how market structure works within the market. I go more into detail about this, like I said, inside my mentorship. You guys, if you have interest in that, just link down below. You can contact me inside the Discord as well. And then if you guys just want to join a great community of traders, link down below to join the Discord. It's completely free to hang out here. You don't have to buy anything. And we all like to help each other out. So if you guys want a community of fellow traders, whether you trade options, whether you trade prop firms, whether you trade futures on a personal account, like, we have people in here from all different parts of the market. I trade all different parts of the market. I do options, I do futures, I do prop firms, I do it all. But if you just want a community of like-minded individuals, like I said, you guys are welcome to join my Discord, link down below. And then if you're interested in being mentored by me and getting the full breakdown on my higher time frame POIs, as well as my entry models to confirm the trade and learn what I call, like I said, is the mic model, which is what I trade. You guys can check out those links down below as well, or contact me on Discord if you have any questions. I'm always around, always happy to answer questions. But if you guys like this kind of content, if you like this video, make sure you hit the like button. If you're not already subscribed, please subscribe to the channel. It all really helps me out. And leave a comment down below. Let me know if this video helped you guys and what you guys would like to see next. Peace.